Let's take some of these points forward with Gaurav Sood, MD and Head of Equity Capital Markets at Avendus. Gaurav, thanks for joining. And, I want to pick up on the second point first. This change in the anchor book participants or, who all can come under the anchor category. Like Sudarshan explained that now up to 40% of the issue, can be put together by anchor investors, and life insurers have been included, pension funds and life insurers have been included. What do you think will the implications be? Because as within that, there are those subcategories which are reserved, and if they're not exhausted, then they go to the other entity. How will the whole process of getting your anchor investors change, and what does that mean for IPOs?
Hi, good morning, first of all. We think that this latest revision of increasing the bucket of domestic investors is a very, very welcome move. It's very constructive. And just to sort of step back, initially what used to happen till these guidelines came, 1/3 of the anchor book was reserved for mutual funds. So the good part is that stays intact. But overall, the reservation for the domestic pool from that 1/3 is now moved to 40%. Which basically means today insurance companies and pension funds, which are becoming very important as part of the capital market journey, they also have that incremental 7% reservation. So it's not just for the mutual funds, even domestic insurance firms and pension funds, which are long-term in nature and have a long-term horizon, can participate, versus in the previous construct where the reservation was for mutual funds and the rest of it, the 66-67% used to be taken up by the FIs plus insurance plus all other categories of investors. The fact that now there is a specific sort of reservation for insurance and pension is a great sign. And basically, we believe this is in line with the what's happening in the market. The regulator and market participants are taking cognizance that these investors are becoming very relevant and large parts of the capital market ecosystem.
So, is it fungible, or will it have to be 1/3 mutual funds and 1/3 life insurance and pension?
See, even till now, it was fungible. When it was 1/3 for mutual funds, there were cases in the past if the mutual fund part of the book was not fully subscribed, the FIs used to flow into the mutual fund. So we still believe, obviously, more clarity will emerge over the next few weeks, but we believe this is fungible. This basically means that if there are insurance firms also participating, extensively, then they can be part of that 40%. If they are not there, then the mutual funds, of course, have that reservation. But this is fungible as per what we understand.
What do you make of the minimum public shareholding norms which have been revised? The timeline has been extended for mega caps, for super mega caps, and extended compliance up to 10 years for achieving the 25% MPS. This reduces the immediate supply overhang. How do you, view this as an opportunity? But at the same time, also because there is no immediate supply and the float would be, very limited, that may cause big price moves also.
Yeah. So I think this is in line with the times. When these guidelines sort of came into practice about 12, 15 years back, at that point of time, Indian primary market were, I would say, reasonably thin, not as robust as probably today. The average IPO size 10 years back was $60 to $75 million. Today, an average IPO size is $200 million, where more than 10 to 15 IPOs every year are close to billion, and some of them are now the mega billion IPOs that have already happened and expected to happen in the next couple of years. So this is a very welcome move. We believe that it basically, from an issuer perspective, the challenge was to not just manage the initial offering, which used to be closer to 10%, or for market caps greater than 1 lakh crore, 5% plus 5,000 crore. The way this has been structured, it's beautifully structured, that you can manage a float close to $3 to $4 billion, irrespective of your market cap, and a longer time frame has been given to these issuers to come down to 25%, which basically means coming down to 25% is more strategic, can be more strategic in alignment with how the company grows and their growth objectives, versus a 3-year time frame where sometimes there might not be enough strategic opportunities for a promoter to bring down the shareholding to 75%. So absolutely a marvelous move by SEBI on this. And basically it is showing that India is getting ready for the next set of IPOs, which will be 3, 4, 5 billion, and companies closer to 100 billion or plus are going to hit the market soon.
And that's our last question, Gaurav. What's your estimate? How much more IPO supply in the next couple of months? Give us some estimate, and the big ones that you're watching out for. How much more paper?
Yeah, so I think our sense is if the markets remain the way they are, and little bit of volatility here and there doesn't really impact primary markets as we are seeing, another at least $10 to $12 billion worth of IPO should come in the next 3-4 months. 5-6 of them would be $1 billion or plus, or could be probably 8 to 10. But primary markets continue to be robust. We are seeing, institutional investor interest across India, across FII category, and recently an IPO closed on Friday, which is probably 100 times subscribed, and multiple times subscribed across investor categories. So markets remain robust, and primary markets should absolutely lead by example.
Vibrant as well. Gaurav, work hard and keep the tennis going. Thank you very much for joining us. And
Thank you.
we'll speak soon again.